You've been dreaming about making big moves with your money. Maybe you've been saving up for that shiny new car, or perhaps you're eyeing a cozy apartment of your own. You check your bank account, and the numbers make you feel proud. You're ready. So you walk into a bank confident. You fill out the application for an auto loan, hopeful. The bank tells you no, not enough credit history.
Your credit score isn't just a number, it's the key to your future. Here, you'll learn simple, proven strategies to build, repair, and master your credit, step by step. No matter where you're starting, this is the place to take control of your financial journey. Subscribe now and unlock the financial freedom you deserve.
You leave, confused. You've been responsible with money your whole life. You pay your bills on time, you save diligently, and you've never borrowed a dime. But from the bank's perspective, you're a mystery, a blank page. And in the world of credit, mystery isn't rewarded. You try another lender. This time, approval comes, but the interest rate is astronomical, 16%. It feels like a punishment for something you didn't even do wrong. But the reality is simple. The lenders don't know you. They can't tell if you're reliable or reckless, so they take the safe route. They charge higher rates or deny you outright. Having no credit is not the same as having bad credit. There's no past misstep to account for, no overdue payments, no maxed out cards, just nothing. And that nothing can be just as limiting as a negative history when you're trying to access loans, cards, or even some apartments. The frustrating part? The only way to build credit is to use credit. The only way to use credit is to have it. And the easiest way to get it is to already have a credit history. It's a loop, a classic catch-22 that leaves many people feeling stuck before they've even started. But here's the good news. There's a way out. There's a methodical, step-by-step way to build credit from scratch. It requires patience, diligence, and a little planning, but anyone can do it. And if your long-term goals include buying a car, owning a home, or even qualifying for a low-interest loan, investing the time now will pay off exponentially in the future. Upbeat electronic music plays, coins clanging lightly in the background. Let's start from the very beginning. Understanding credit. Credit is essentially a measure of trust. It's how lenders decide whether you are likely to repay money you borrow. Think of it as a report card, but instead of grades for math or English, you're graded on how responsibly you handle money. When you have no credit history, it's like showing up to a classroom on the first day with no records at all. Teachers don't know if you're a straight-A student or someone who skips class. Lenders feel the same way. They don't know if you're disciplined with payments or if you'll disappear the moment a bill comes due. Your credit score is the numeric representation of this trust. It's a 3-digit number that lenders look at when you apply for anything from credit cards to car loans to mortgages. Scores usually range from 300 to 850. The higher the number, the more trustworthy you appear. The lower the number, the more cautious a lender will be. And here's the kicker. Without a history, you're often starting at zero or close enough that lenders see you as high risk. Credit reports and scores are calculated using several factors. The most important ones are payment history. Are you paying your bills on time? Credit utilization. How much of your available credit are you using? Length of credit history. How long have your accounts been active? Credit mix. Do you have both revolving credit and installment loans? Inquiries and new accounts. How often are you applying for new credit? Payment history is the biggest factor. Even one late payment can significantly affect your score. Credit utilization comes next. If you have a credit limit of $1,000 and use $800 of it, lenders see you as potentially overspending. If you only use $100, you look disciplined and reliable. Length of credit history is harder to influence immediately. It simply takes time. Credit mix is about balance. Lenders like to see that you can responsibly handle different types of credit. Inquiries and new accounts are less impactful individually, but if you open many accounts in a short period, lenders may assume you're desperate for credit. That's a red flag to lenders. Building credit from zero isn't just about getting approved for a card. It's about showing consistency, responsibility, and financial maturity over time. And once you understand how lenders evaluate you, you can start to make strategic moves that boost your credit quickly and safely. Starting with pre-qualification. The first step to building credit from scratch is understanding pre-qualification. Pre-qualification is like testing the waters. It allows you to see which credit products you might qualify for without making a hard impact on your credit score. In other words, it's a risk-free way to explore your options. Many banks and credit card issuers offer pre-qualification tools online. You fill out basic information like your income, age, and some personal details, and the lender gives you a preliminary answer. This does not count as a hard inquiry, so your credit score remains untouched. Why is this important? Because applying blindly to multiple cards or loans can actually hurt your score. Each official application is reported as a hard inquiry, and too many in a short period can signal that you're desperate for credit. That's a red flag to lenders. Pre-qualification gives you a blueprint. You'll know which options are likely to approve you and which are dead ends, saving both time and potential damage to your score. When you pre-qualify, you're essentially getting permission to play the credit game without committing yet. Think of it like auditioning for a role. You're showing up, letting them see your potential, but you haven't officially signed the contract. Once you've pre-qualified and found options that fit your situation, the next step is to decide which type of credit is best to start with. For most people beginning from zero, this means one of two paths: a traditional unsecured credit card or a secured credit card.
The choice between them depends on your current credit profile and financial comfort. If you already have some minimal credit history, an unsecured card may be within reach. But for most people starting completely fresh, a secured card is the fastest, most reliable path. It might feel like borrowing your own money, but in the eyes of the lender, you are building proof that you can manage credit responsibly. Pre-qualification is your roadmap. It tells you which cards or loans are realistic, which keeps you from wasting time, money, or future credit opportunities. Once you're confident in your options, you can move forward with the application process and start laying the foundation for a strong credit history. Secured cards and how they work. If you're starting from zero credit, a secured credit card is often your best friend. At first, it might feel a little strange. After all, you're essentially lending the bank your own money. But that's exactly what makes it a safe and effective way to build credit. A secured card works by requiring a deposit, which typically sets your credit limit. For example, if you deposit $500, you'll receive a credit card with a $500 limit. From the lender's perspective, the deposit reduces their risk. From your perspective, it's a tool to prove that you can handle credit responsibly. Many secured cards offer the chance to graduate to an unsecured card after a period of consistent on-time payments. Others may remain secured indefinitely, so it's important to research your options before committing. Look for cards with low fees, flexible terms, and the ability to report your payments to all three major credit bureaus. Reporting is crucial because if your activity isn't reported, it won't help you build credit. Once you have the card, it's essential to use it wisely. There are two key factors that lenders watch closely: payment history and credit utilization. Payment history is king. Roughly 35% of your credit score is based on it. Every on-time payment is like a vote of confidence to lenders. It tells them this person can be trusted with credit. Even small, consistent payments add up over time. Missing a due date could be costly. If you miss your due date, you may incur a late fee. If it goes more than 30 days, the missed payment will be reported to the credit bureaus. That's when your score starts to drop. And even after it's reported, it can take months or even years to fully recover. The lesson is simple: set reminders, automate payments if possible, and always pay at least the minimum due on time. Now let's talk about credit utilization. This is the percentage of your available credit that you're currently using. Lenders like to see that you're not maxing out your cards. High utilization suggests you might be overextended and could have trouble making payments. Low utilization suggests discipline, financial control, and reliability. Here's a practical example. Say you have a $1,000 limit on your secured card. If you spend $700 in a month, that's a 70% utilization rate. Not ideal. But if you spend $200, your utilization is 20%, which is excellent. Experts recommend keeping it below 30%, and ideally below 10% if you want to build credit quickly. One strategy to manage utilization is to make multiple small payments throughout the month instead of waiting for the statement due date. This keeps your reported balance low, reducing your utilization ratio and improving your credit score over time. Another tip, don't close your first secured card too soon. The length of your credit history also matters, so keeping accounts open, even with minimal activity, can help your score. Lenders want to see consistency over time, not just a single month of good behavior. Ultimately, the combination of on-time payments and low utilization is what starts to transform your no-credit status into a strong, trustworthy credit profile. Over a few months, these actions compound, and you'll notice your score rising steadily, opening doors to better loans and more financial opportunities. Length of credit history, credit mix, and inquiries. While payment history and utilization carry the most weight, other factors also shape your credit profile. These include the length of your credit history, your credit mix, and inquiries from new applications. Understanding these can help you plan for faster credit growth.
Length of credit history is exactly what it sounds like. How long your credit accounts have been open. The longer your history, the more data lenders have to assess your reliability. Unfortunately, this is something you can't speed up overnight, but the good news is starting early sets the clock in motion. Even small accounts, like a secured card, contribute to your credit age. Keeping accounts open and active over time shows stability, which can positively influence your score in the long term. Next is credit mix. Lenders prefer to see that you can manage different types of credit responsibly. This includes revolving credit, like credit cards, and installment credit, such as car loans, student loans, or personal loans. Now, should you rush out and take a big loan just to diversify your credit? Absolutely not. Going into debt you don't need is risky and unnecessary. Fortunately, there's a safer method to achieve a balanced credit mix: credit builder loans. Credit builder loans are designed to help people with little or no credit history. They work like a hybrid between a savings account and a small installment loan. You choose the loan amount and term, but instead of receiving the money up front, the lender places it in a secure account. You make regular monthly payments, which are reported to the credit bureaus. Once you complete the payments, you gain access to the full amount, minus interest. This approach does two things. It builds your credit history with installment payments, and it encourages you to save money. Over time, it strengthens your overall credit profile, contributing to a better score and a healthier financial foundation. Finally, there are inquiries and new accounts. Every time you officially apply for credit, it triggers a hard inquiry on your report. Each inquiry temporarily lowers your score. Applying for too many accounts in a short time can signal desperation, which is a red flag for lenders. To avoid this, apply strategically. Pre-qualification helps here because it lets you explore your options without affecting your score. Managing these additional factors, credit age, mix, and inquiries, alongside payment history and utilization, creates a strong, holistic approach to building credit. Over time, you'll have a profile that's well-rounded, reliable, and attractive to lenders. Piggybacking and authorized users. There's a little-known shortcut to building credit from scratch, and it's called piggybacking. The official term is becoming an authorized user on someone else's credit account. Essentially, another person, often a family member or close friend, adds you to their existing credit card. Their account history, including payments and balances, is reported on your credit report as well. Why does this matter? Because if the primary cardholder has a strong history, low utilization, on-time payments, no missed bills, you instantly benefit from their responsible behavior. It's a way to leverage established credit to jumpstart your own profile. However, there are important rules to follow. The person helping you is taking on risk. If you misuse the card, overspend, or miss payments, it could harm their credit as well as yours. This method is not a free pass. It requires discipline, communication, and trust. For maximum benefit, the primary cardholder should have a long credit history, a high credit limit, and consistently low utilization. Even if your own credit is brand new, you can see an immediate improvement in your score. Some common scenarios include parents helping young adults, spouses supporting each other, or close relatives offering a financial boost. Many banks allow authorized users without requiring the user to be legally responsible for payments, which reduces your risk while still improving your credit history. Piggybacking is especially effective in the first year of building credit. When combined with a secured card and responsible spending habits, it accelerates the process significantly. However, it should not be the only tool you rely on. To build long-term credit strength, you still need to demonstrate independent responsibility through your own accounts. Think of piggybacking as a fast track, not a permanent solution. It gives you credibility quickly while you continue to build your personal credit history through cards, loans, and consistent payment practices. For someone starting from zero, the world of credit can feel like an exclusive party you're not invited to. Every application, every loan, every card seems like a gate you can't open. But the truth is, you can get in. You just need to know the rules. It all comes down to building trust. Payment history, credit utilization, length of history, credit mix, and even smart use of authorized user accounts, all of these pieces fit together like a puzzle. Each on-time payment, each responsible decision, each low utilization ratio is a brushstroke in the portrait of a reliable borrower. Over time, that portrait becomes clear to lenders, and the doors that once seemed closed begin to open. Building credit isn't instant. It requires patience, discipline, and intentional choices. You'll face moments of frustration, waiting for a score to rise, watching interest rates that feel high, but every small step counts. Each month of responsible use compounds, and before long, your credit is no longer a mystery. It tells lenders a story that you are dependable, capable, and financially trustworthy. Whether you're planning for a car loan, a first home, or simply financial peace of mind, starting now sets the foundation for future success. The tools are available: secured cards, credit builder loans, pre-qualification, and careful management of your own spending. Combine these with smart strategies like becoming an authorized user or maintaining low utilization, and you'll see your credit history grow steadily and reliably. In the end, building credit from zero is more than a financial exercise. It's a practice in responsibility, foresight, and patience. The journey may feel slow at first, but with consistent effort, you transform from a blank page into a trusted borrower ready to take on the financial opportunities that once felt out of reach.